What's going on, everybody? It's Jeff here. Welcome back to the channel. AMC green on the day with just under an hour into close. Something that happened overnight into this morning I want to talk about. I am going to put in a complete visual on everything that happened, the reasoning behind it, and also I hope that everybody can get a really good understanding of why so many people are saying the exact same thing that I am. So stick to the end. It's going to completely blow your mind and you're going to understand exactly why this is happening. So let's get right into it. First off, right away, first thing in the morning, was about 6:30 a.m. I tweeted AMC 85, 90, and 95 strikes were added to the options chain. Don't be dumb. We've talked about the options chain. I've talked about it numerous times. I've talked about what the market makers do on Monday and Tuesday. I've talked about why AMC has become insanely risky for options. The implied volatility is astronomically high, and many people just don't understand how options and the Greeks work. Well, in this video, I'm going to explain everything and I'm going to give you an exact visual on what happened. So first off, let's take a look at the options chain. Let me refresh this real quick to give you the most up-to-date volume on this. If you look right here, this is the 95, the 90, and the 85 that is set to expire this Friday. There are over 30,000, almost 40 plus thousand contracts worth of volume that have come through on these three strikes. So this is what this tells me right here. Either there are still some individuals that do not understand how options work, or this is large hedge funds that are short, that are purchasing these insane out of the money contracts in order to help offset that delta from the market makers and try to make the swing back to be what's called delta neutral. I'll explain that in just a minute. That's exactly what this tells me here. If you look at this IV, it's actually higher than 400, which is astronomically insanely high. You pay that direct in your premium. Let me paint a picture for you in very simplest terms on what would have happened if you purchased any of these strikes this morning. I'm going to refresh this one right here. Right now, the current price is 28 cents for the 95 strike on August 27th. But look at this number. The day's range was 27 cents to 89 cents. And you might be thinking to yourself, if I purchase this first thing in the morning, we are green, how could this strike be down 60%? Take a look at the 90. Same thing. High was $1. The 85, I think it was even a little bit higher. It was $1.12 maybe? $1.12. You're down right away. Why? Because one, the theta is going to absolutely murder you. The time decay, you have no time for your options, and the implied volatility. This is what the market makers are doing and yoinking all of your money if you're still buying these. Now, if you might be thinking to yourself, okay, well, that's just the August 27th strike. Let's look at the September 3rd, even more time. High of 245, you're down 50%. September 10th, high of 310, you're down about 40%. September 17th, high of 380, it's at 246, you're down about 30% right away. AMC is green, and if you purchased any of these options, you are down money. This is why there are many people saying don't buy options. Now, I know some people that are saying right off the rip, don't buy options, buy shares. They're saying that because that's their own, ulterior motives, and they don't even understand how the options chain works. But this is why I said it. Don't fall for it, because the Greeks, the numbers, the metrics that I've looked at for years and years do not make sense in order to be beneficial for somebody who would be interested in buying a call. And it doesn't matter that it's AMC. If I ever saw these numbers on any stock, whether it was, one for a squeeze play, doesn't matter what it is, these numbers are something I would insanely stay away from. Now let's talk really quickly about this whole delta neutral, which I'm sure you've heard for a long period of time. Basically, these market makers will sell these options. Market makers are the number one sellers of options. They will sell these options naked. They can do that because they have a massive backing. And their goal is to say what's called delta neutral, which means your risk is mitigated by your reward. It's very simple. They make money on the spreads and anything they get to keep in between, but that's their goal. And when this numbers, if you look in here, you have your delta puts, your delta calls. When they stay too far away from that zero, that's when things become sketchy. And if it becomes too high on the call side, the market makers will need to go out and purchase shares in order to hedge their position. So you might be thinking to yourself, okay, well, if I bought the $95 call, what is that doing? Well, it's actually offsetting the delta because the market makers are not hedging for a $95 strike when the price is in the mid 40s. They're not doing it. So it's offsetting their delta. That's why at the beginning of this video, I had said it's not going to be a bad idea for these large hedge funds that are short in the morning or mid-afternoon to go out and buy, 10,000 contracts, 5,000 contracts, even though they're going to throw away that money because they might be throwing away $250,000 or whatever it is, not $250,000, $250 million bucks, whatever it might be, in order to prevent billions from losses. I talk about it. Whoever's in part of the group and you've been watching my channel for a long period of time, you know that I always talk about purchasing the VIX, okay, as a hedge position. I'm okay throwing that money away as long as my portfolio keeps on riding up. But just in case there's a little bit of a pullback, I at least get to get a little bit of capital on this. It's called managing your risk. And that's what these large hedge funds are doing. And that's exactly what, like I said, it could be a very good probability that they are some of the ones that are buying these insanely long out calls. But I know some people are just like, I'm not buying options anymore. I've been burned too many times. And some of you new people might be thinking to yourself, oh, well, it's cheap to only buy a $75 contract when it's like your chance of winning. I said yesterday to go either put the ball on the roulette table at 11 or 17, might as well just go put it on 32 because I never see 32 as a winner. Okay, and 11, 17 are my favorites. But point of the matter is that you're not going to win with this. So I hope all of you were really able to understand exactly why I said this. And it's not, I know everybody else is just like, oh, don't buy options, don't buy options, don't buy options. But the reason being is because of what they're offering to you. They're offering you, you're paying for a $50 steak dinner, and they're giving you like a 4-ounce, bottom round, sirloin piece. It's, they're portraying it like it's something amazing, and they're giving you nothing. The value isn't there. And this has to do with any single stock, not just AMC. That's why I am talking about it, but specifically for AMC. So I hope you seeing exactly what these numbers are and how I was able to show you. Look at this. I don't even know where the price is. Let's take a look at AMC. Okay, it did dip a little bit, but look at that. From just my time talking to you, the $95 strike went down, I don't even know, maybe another 10 cents, something like that, in the matter of, 8 minutes I've been into this video. So I hope that this day's range really gave you a good understanding of how options work, why when that implied volatility is insanely high. I know it said 400%, I think it's somewhere in the 500% for this actual strike, astronomically high. I hope it really gives you good understanding. And if you are one of those people that is just totally against buying options for AMC, then awesome. I hope you remember this video for the rest of your trading career and you choose to possibly stay away from options, buying options when the implied volatility is insanely high. So that's it for this video. I'll see you in the next one.